Part 1, Introduction. Baseball is often referred to as a sport of statistics. Numbers like batting average, on-base percentage, and OPS prove a player's value. However, since 2019, the most critical numbers dominating Major League Baseball are no longer the scores on the board. They are IRR, internal rate of return, and AUM, assets under management. We often go wild over news like Shohei Ohtani signing a $700 million contract. Yet behind the scenes, we tend to overlook whose hands the equity of the teams themselves is passing into. Currently, the MLB market superficially appears to be the solo stage of a single private equity firm called Arctos Partners. They have rapidly absorbed stakes in almost every prestigious club we know, including the Boston Red Sox, Los Angeles Dodgers, Chicago Cubs, and San Francisco Giants. But this is not a one-dimensional story about a wealthy fund simply entering the ballpark. This is a proxy war for the Wall Street giant KKR. Let me set the stage for the characters in this drama. First is Blue Owl Capital, formed by Mark Lipschultz, a former key figure at KKR, who went independent and merged with Dial Capital. This fund opened fire on the sports PE market by sweeping up NBA teams. Second is KKR. Watching Blue Owl, which shares its DNA on a winning streak, KKR, the original home, chose a more subtle strategy instead of engaging in a muddy fight to win deals directly. They became the backer of the market's rising number one, Arctos Partners, by acquiring a stake in them. In other words, the aggressive expansion of Arctos currently unfolding in the MLB is a massive capital war, a KKR civil war, between KKR's proxy, backed by KKR Capital, and the ace who left home that has conquered the NBA. From now on, we begin the real Moneyball taking place off the field. Part 2, the mechanics. 1. 2019, the gates open, the collapse of the one-fund rule. The MLB Secretariat's revision of private equity investment regulations in 2019 was not merely deregulation. It was a structural declaration of surrender, proclaiming that the nature of baseball teams as assets had completely shifted from trophy assets for tycoons to financialized assets. Why surrender? The reason is clear. Team valuations had risen too high. In the past, local dignitaries or successful entrepreneurs could buy teams with personal funds. However, as the value of major clubs breached the $3 billion and $4 billion marks, it exceeded the limits of liquidity that individuals could handle. Owners fell into a liquidity trap where they could not find individual buyers to take on such massive stakes, even if they wanted to sell equity to secure cash. Accordingly, in 2019, the MLB introduced a new mechanism called the Rule of 1530. Rule 1, a single club can sell up to 30% of its total equity to institutional investors. Rule 2, a single fund can own up to 15% of a single club. The implications of these numbers are precise. 30% is the Maginot Line that provides owners with sufficient exit opportunities without threatening management control. The 15% cap is a safety device that fundamentally blocks specific funds from raising their voices within the club. In essence, the MLB opened the door on the condition of silent capital, providing money but keeping their mouths shut. 2. KKR's design, fighting through a proxy. Here the curtain rises on the KKR civil war. Competitor Blue Owl Capital preempted the NBA market, directly targeting the Phoenix Suns and Sacramento Kings through a dedicated fund called Dial Homecourt. This is akin to a field commander jumping directly into the battlefield. In contrast, KKR, the king of Wall Street, moved differently. After analyzing the MLB market, they avoided the war of attrition involved in negotiating with each club individually. Instead, they focused on a nascent house that already had close ties with the MLB Secretariat, Arctos. KKR volunteered to be their funding source through a strategic alliance with Arctos, essentially a GP stake investment. This is KKR's signature platform strategy. Winning individual deals is exhausting. However, if you control Arctos, the platform that sweeps up the deals, you control the entire market. Consequently, Arctos, backed by the massive capital of KKR, acquired the status of an implicit preferred partner of the MLB Secretariat. For the MLB, it is more convenient to have Arctos, a single entity that is easy to control and has certain financial power, organize the market rather than having various unverified PE firms scrambling about. The result is the Arctos monopoly phenomenon we are currently witnessing in the MLB. 3. Evolution of deal structure. Buy the holdco, not the club. Amidst this regulatory environment, Arctos and Redbird Capital showcased a highly sophisticated deal structure, the holding company investment method. The most representative case is the Boston Red Sox deal. Arctos and Redbird did not inject money directly into the Red Sox club entity. They acquired stakes in Fenway Sports Group, the parent company that owns the Red Sox, Liverpool FC, and the Pittsburgh Penguins. There are 3 reasons why this structure is impressive. First, regulatory circumvention. The MLB's stringent owner approval process can be simplified or managed flexibly by handling it as a shareholder change at the parent company level. Second, risk hedging. It reduces the risk of going all in on a single baseball team and enjoys the effect of diversified investment across a multi-sport portfolio, including soccer and ice hockey. Third, valuation arbitrage. Individual club stakes suffer from illiquidity discounts due to low liquidity, but stakes in a massive sports group can be recognized for high valuations, akin to a management premium during a future IPO or total sale. Arctos applied this method to the LA Dodgers as well. They purchased a stake in Guggenheim Baseball Management, the owner group, rather than the Dodgers club itself. This is not a simple equity investment, but a structural device that elevates them to the partner level with the owner families. 4. San Francisco Giants and Chicago Cubs, cashing out old money. On the other hand, for the following clubs without holding companies, they proceeded with direct equity acquisitions. Regarding the San Francisco Giants, in 2021, they acquired a 5% stake based on an enterprise value of approximately $3.2 billion. Regarding the Chicago Cubs, they acquired a portion of the Ricketts family's stake. The commonality in these deals is stability. The Cubs and Giants are akin to bond-like stocks with guaranteed cash flow, boasting certain audience mobilization power regardless of performance. For KKR and Arctos, these deals serve as a reliable cash cow that protects the downside of the portfolio. To summarize, the deregulation of 2019 as the unlocking of the MLB began with the liquidity crisis of team owners. KKR seized upon this, entering the market through their proxy, Arctos. And by attacking the higher-level structure known as the holding company, moving beyond simple equity investment, they are executing a task to incorporate the entire league into their own portfolio. Part 3, the precedents. 2 giants, 2 strategies. 1. Strategy conflict. Redbird, the operator, versus Arctos, the aggregator. To understand KKR's proxy war in the MLB market, we must compare the conflicting investment DNA of the 2 major players dividing the current market. On the surface, they both appear to be private equity firms injecting money into sports teams, but the investment philosophies underlying them are completely different. We can define this as Redbird's precision strike versus Arctos's carpet bombing. First, Redbird Capital Partners, the value creator, the operator. Redbird's investment in the Boston Red Sox is not simple equity participation. In 2021, they deployed approximately $735 million to secure an 11% stake in FSG. The core of this deal was network, not capital. Redbird brought LeBron James in as a shareholder in this deal. This was a powerful signal. We don't just give money, we will combine your intellectual property with a global icon like LeBron to maximize value. Indeed, using the FSG investment as a foothold, Redbird expanded its portfolio by acquiring the European soccer powerhouse AC Milan. In short, Redbird is an active strategist that actively intervenes in club management to attach media and entertainment businesses, proactively boosting enterprise value. They focus on a few definitive targets to create depth. Second, Arctos Partners, the portfolio buying the whole league, the aggregator. In contrast, the strategy of Arctos, supported by KKR, is akin to an index fund. Their portfolio includes the Boston Red Sox, LA Dodgers, Chicago Cubs, San Francisco Giants, Houston Astros, San Diego Padres, and Texas Rangers. Arctos does not attempt to improve the management of specific clubs. Instead, they bet on the growth of the MLB league itself. Within the rules of a 30% total cap and a 15% single fund cap, they swept up small stakes in every possible blue-chip club. Effectively, subscribing to the Arctos fund produces the same effect as buying an MLB ETF. The frightening aspect of this strategy lies in the preference of the owners. Owners prefer Arctos, silent capital that quietly provides money and takes dividends without interference, much more than smart partners who meddle in their management rights. Arctos accurately exploited this psychology to monopolize the market. 2. Comparison. Parallel theory and intersection with Blue Owl. Now let's widen our view to compare with competitor Blue Owl Capital. Blue Owl preempted a similar position in the NBA market as Arctos. They invested heavily in the Phoenix Suns, Sacramento Kings, and Atlanta Hawks, building a brand as an NBA specialist PE. However, the structural difference in the KKR Civil War becomes apparent here. Blue Owl focused on direct investment at the NBA club level. This involves relatively smaller deal sizes and exposure to the risks of individual clubs. On the other hand, Arctos made holding company investment the standard in the MLB. When Arctos bought into the Boston Red Sox, they bought the parent company, FSG, not the club. When buying into the Philadelphia 76ers and NJ Devils, they purchased stakes in the parent company, HBSE. They approached the Utah Jazz through its parent company, SEG, as well. This is structural arbitrage, one level higher than the tactics employed by Blue Owl. Individual clubs see their value fluctuate based on game performance or player injuries, but holding companies controlling multiple sports have diversified cash flows, making them far more stable. From a financial engineering perspective, Arctos has completed a structure that offers lower volatility and commands higher valuation multiples than Blue Owl's portfolio. 3. Implications of precedence. Will Arctos' dominance continue? When Redbird paved the way by acquiring an 11% stake in FSG, Arctos followed, adding their name to the FSG shareholder list. This is symbolic. It is a typical predatory mechanism of capital where a pioneer takes risks to open a market and then massive capital enters to pacify and conquer that market. However, risks exist. Arctos holds too much equity in major MLB teams. This is a conflict of interest issue. When the Dodgers and Giants play, who should Arctos, holding stakes in both, cheer for? While there are no legal issues as they hold minority stakes without management rights, checks and balances against their bloated influence within the league may be triggered. Nevertheless, our conclusion is a win by decision for Arctos. If Redbird showed off flashy technique, Arctos pushed through with overwhelming weight class. What the owners wanted was not innovation, but immediate liquidity in their pockets, and Arctos solved that need in the simplest way. This is likely the reason KKR chose the simple and powerful pipeline called Arctos instead of stepping forward directly. Part 4. The incentives and future outlook. No way out and last man standing. 1. Incentive analysis. Why minority stakes now? We must ask a fundamental question here. The standard for private equity is the buyout, acquiring management rights, increasing enterprise value, and then selling for a profit. So why are Arctos and Blue Owl pouring billions of dollars into so-called toothless minority stakes that offer no management control? There are two main reasons. First, the incentive for the owners. It is a case of being asset-rich but cash-poor. The dilemma for MLB owners is paradoxical. Team valuations have skyrocketed to $4 or $5 billion, but these are merely numbers on a ledger. They lack immediate cash to pay player salaries or fund stadium renovations. The San Diego Padres are a perfect example. The Padres faced tight finances due to aggressive player acquisitions and had a strong need for external capital raising. It was too expensive to take on more loans due to interest rates, and it was a wasteful time to sell the entire team. At this moment, Arctos appeared like a savior. Keep your management rights. We will just give you cash for a 10% stake. The Ricketts family of the Chicago Cubs also transferred a minority stake to secure liquidity based on stable cash flows. In essence, for owners, PE is the safest ATM that injects cash without threatening their control. Second, The incentive for investors. The magic of zero correlation. KKR and Arctos are not targeting the popularity of baseball. The data they focused on is the historical fact that sports team values trend upward regardless of the S&P 500 index or economic recessions. Even during financial crises, people watch baseball. If inflation rises, they simply raise ticket prices and broadcasting rights fees. From a portfolio manager's perspective, MLB equity is a perfect alternative investment asset that can hedge against stock market volatility. In particular, as seen in the Texas Rangers case, if a jackpot like winning the 2023 World Series occurs, the massive valuation gain from the re-rating of the club's value is a bonus. 2. Future outlook. Opening the NFL and completing the Grand Slam. The front line of this KKR proxy war has now expanded beyond the MLB and NBA to the final sanctuary, American football. In December 2024, the notoriously conservative NFL finally approved private equity investment, and the protagonist of this historic first NFL deal was, once again, Arctos Partners acquiring a 10% stake in the Buffalo Bills. With this, Arctos has achieved the so-called Grand Slam, becoming the first firm to hold major stakes in all four major U.S. sports leagues: MLB, NBA, NHL, and NFL. This signifies that KKR's big picture has entered the completion phase. Arctos is no longer just an investment firm. It has become a massive financial infrastructure penetrating the entire U.S. sports industry. 3. Strategic implications, eventually resulting in holdco IPOs. The final endgame of this massive game we predict is clear. There is a limit to selling fractional stakes in individual clubs. Eventually, they will list the sports holding companies themselves on the stock market or bundle them to securitize a massive fund. The signs are already distinct. In the case of FSG, which owns the Boston Red Sox, Liverpool, and the Pittsburgh Penguins, it is effectively a global media conglomerate that has simply not listed yet. Furthermore, HBSE, owners of the Philadelphia 76ers and NJ Devils, and SEG, owners of the Utah Jazz and Utah Hockey Club, are also increasing their bulk. This holding company model, which allows investors to enjoy the effect of diversified investment across multiple sports by investing in one place, heralds the birth of sports chaebol, conglomerates. As major shareholders of these holding companies, Arctos and Redbird will likely exit by realizing astronomical profits when these entities are listed on the NASDAQ in the future. This is the true ending credit of Moneyball, designed by KKR and executed by Arctos. Part 5, Conclusion. The Syndicate's Note. The MLB legend Yogi Berra left the famous quote, "It ain't over till it's over." However, from the perspective of the capital markets, the game in the MLB might already be over. The winner has been decided. It is financial capital. Today we track the full story of the KKR Civil War taking place behind the flashy home run shows. From the moment the MLB Secretariat unlocked the gates in 2019, this market ceased to be a social club for romantic owners. It has transformed into an alternative investment asset market dominated by thoroughly calculated IRRs and multiples. The phenomenon of Arctos Partners monopolizing stakes in major clubs like the Dodgers, Cubs, Giants, and Red Sox is no coincidence. It was a highly sophisticated platform strategy where the massive capital of KKR, without getting blood on its own hands, utilized a proxy called Arctos to most efficiently seize control of the entire league. On the other hand, Redbird Capital presented a new equation through the FSG holding company model, evolving clubs from simple sports teams into global entertainment corporations. Now, when you visit a baseball stadium, think not only of the players on the field, but also of the private equity managers sitting somewhere in a VIP box. What they are cheering for is not our team's victory, but a monopolistic position and exit timing. The MLB is no longer just a sports league. It is rapidly transforming into the most sophisticated and safe derivative financial product designed by Wall Street.